we've been cautioning investors not to do anything rash in this environment. We continue to be overweight equities, kind of quality growth securities. We continue to like the margins in technology and the growth rates in technology, even though they've come down. And we like the non-cyclical nature of things like healthcare and staples. So as we head into this earnings season, we think those sectors in particular are likely to hold up better than cyclical parts of the economy or more defensive parts of the sector lineup.
How are you thinking about valuations? Because with staples in particular, there are some areas that are incredibly expensive, even healthcare technology, even after the recent declines. So, there's a big split right now between people like we talked to last hour who want to take now to buy things they like at a low price, and the kind of strategy you're advising, which is to buy businesses you think will hold up relatively well now, even if they're at a high multiple.
Yeah, so I think what's happening here with earnings and multiples, most investors and corporate executives are in the dark. And so I think until we reopen for business, it's going to be difficult to determine on traditional metrics on what to buy or sell at this point. So I think a lot of this earnings season's going to have to deal with investors' interpretation of future growth expectations. So looking at how cyclicals trade relative to defensives is something I'm keeping an eye on. The relative performance of bank stocks will give me an indication on how comfortable folks are with kind of the rebound that we may or may not get. Credit spreads will be important, and certainly kind of how copper and oil are trading will give us indications again about future growth prospects. Getting too tied down on the earnings, today's earnings, and the forecasts, which have largely been abandoned, I think is a recipe for disaster.